What's going on, traders? My name is Shark. Hope everybody's having a great weekend. I wanted to do a quick video here going over what I saw as the real fundamental cause in that huge sell-off in the gold contracts on Friday. At one point, the futures contract was down, I think, even over, just a little bit over 600 points, which is just an unprecedented move in the instrument itself, and we're really seeing some massive volatility here. The Sunday market Globex has opened, and we're seeing a rally. It's up about 2.5% now, up about 127 points. So really crazy moves we're seeing in gold. And I want to talk about what's really going on here in the rally, the end of the month sell-off that we just saw, and why this wasn't a sudden macro shock. It was really a relative valuation rotation. So for me to explain it properly, we're going to have to stop looking at equities in dollar terms, and we're going to look at them in gold terms, right? So I have created this indicator right here that does just that. And when you price equities in gold terms, you strip out the dollar, right? You're no longer asking, are stocks going up? You're asking, are stocks gaining or losing real purchasing power? And that's the big difference here. So on this chart, the blue line, or cyan, whatever you want to call it, is the S&P priced in gold, right? This yellow line here is the real yield pressure proxy, basically telling us whether rates are helping or hurting equities relative to hard assets, okay? And what we saw over the last few weeks is not, an equity collapse. Mostly the S&P has been selling off a little bit, but structurally we're fine overall. Equities, obviously didn't implode, but gold aggressively outperformed, right? And that caused stocks in real asset terms to reach relative lows. And you can see here, this is the S&P, as I mentioned, priced in gold, just this downtrend, breaking almost to this 60 level, really, really low. And actually, let's zoom out just so we can kind of see historically where this kind of lines up in. Okay, let me collapse this a little bit. Okay, so, we have been lower before, obviously, but you can see here that we're almost by the 2020 lows. As a matter of fact, we did dip just below it, and now seeing that bounce back. So we'll see if that does capture that. But it just really, we're 6 years we're at the lows, basically, from 6 years ago if we reprice here in gold. And so this indicator that I've built here does two important things. First, it tells us who is cheap and who is expensive. Stocks versus gold using historical percentiles, and whether gold is at a premium, So right now, we are around the 4 percentile, right? And the z-score, which is basically a standard deviation, near -3, the third standard deviation to the downside. And that means right now that stocks are cheap versus gold, versus roughly 96% of time over the last decade, right? That's extreme, not emotional, not narrative driven. That's statistically extreme. This isn't saying buy stocks today. It's just saying that the relative valuation gap between stocks and gold now have become too far stretched, right? And what this kind of imbalance builds is large funds don't need, a new macro headline to act, right? They see this, they rebalance, right? And this was the end of the month. No surprise that this happened here at the end of the month, right? Gold became stretched on a relative basis. Stocks now are cheap in real asset terms, right? So what we saw end of the month, allocations get reset, exposure gets trimmed, and that's why we see this hard sell-off, right? So gold sold off hard. Equities were down a little bit, but again, nothing really changed as far as structurally for equities quite yet. But overall, as far as the gold trade is concerned, now we're going to have to wait maybe for a little bit of a stronger pullback if we're looking for potential entries. But in the macro now narrative, with the dollar and the stuff that I have gone over before on my Twitter, that has not changed in my opinion here. So the most important point is that this move wasn't about fear disappearing or fundamentals improving overnight. It was all about relative valuation snapping back from an extreme. So when you look at markets through a real asset lens, these moves make a lot more sense, and they happen before headlines that explain them. So if you guys enjoyed this, I will keep updating this framework as conditions evolve. But right now, the takeaway is pretty simple. This was just a rotation, rebalancing, not some fundamental shift in a macro context of what's going on with the market and the dollar, etc., as I mentioned before. So if you found this helpful, hit like, subscribe. I'll keep breaking down the market this way, time to time, and I hope you got some value from it. All right, guys, take care, and we'll see you later.